Big cap tech stocks are a sucker's bet. You heard it here first. Big cap tech stocks are a sucker's bet. That's clickbait, my friends, because what I'm going to share with you today is the number one guy you should look at when it comes to your research if you're doing any investment prognostication. Not for individual stocks, not for any of that, because that's just silly to do. If you follow the Wall Street Journal at all, you'll know back in the day they used to take monkeys throwing darts at a stock table, and the monkeys would do just as well as professional money managers who were charging their insane fees. So we know there is no validity to individual stock research. Just read Burton Malkiel's Random Walk Down Wall Street, and I won't get into that here. But I want to share with you this article from 2000, because I think you'll like a lot what we're going to talk about here. So welcome to Heritage Wealth Planning YouTube channel, my friends, the place you come to learn all about planning, investment planning, financial planning, tax planning. Planning. So as you can see there, see that little subscribe? That should always remind you, subscribe, brainwashing you, my friends, subscribe. Hit the subscribe button and don't forget to hit the bell to be notified for future content. So let's dive right into this. I tell you, this. So big cap tech stocks are a sucker bet, says Jeremy Siegel in March 14th of 2000. Now, you got to have a paid subscription to the Wall Street Journal to read the whole article, which I don't. I haven't read the Wall Street Journal in years, about 6-7 years, something like that. I used to subscribe religiously. I had a stack of Wall Street Journals, and I'd come home at night saying, I got to read all these over the weekend. And it was good. I learned a lot, but at the end of the day, I just frankly don't care. So, you can. There's nothing wrong with that, But anyway, so you want to have the paid subscription, by all means do so. If you are going to do that, at least read the op-ed page. The op-ed page used to be run some pretty good capitalists who understood the difference between free trade and tariffs. And now they're bashing on Trump because they think Trump is all about tariffs and they're all for free trade. I said, wait a second. How's it free trade if we have to pay 25% for our goods to be exported and we get their goods without any tariffs? That's not free trade. That's a one direction trade mechanism, and the Wall Street Journal has just fallen hook, line, and sinker for just because you call something free trade, that means it's free trade, and absolutely it's not. Free trade is there's no tariffs on anything, and certainly Trump isn't to blame for tariffs, that's for sure. Regardless of what you think about that guy, don't care. The idea there's free trade in this world is silly. For some reason, the Wall Street Journal seems to think that just because you say North American free trade agreement, that's inherently free trade. And I just don't agree with that in the least. Not in the least, especially when sweatshops that Nike, for instance, are using to build your tennis shoes, which I have, I grant you. We know that the Chinese are marketing out to slave labor camps in North Korea. Again, don't tell me that's free trade. And then, we have people call for fair trade. And I'm a little bit more, I like the idea of fair trade a little bit more. I think, again, a lot of this stuff is just political virtue signaling, frankly. But I like the idea that, hey, these guys in Korea are literally being run to death in their sweatshops to build you a product that they're going to sell over here with minimal tariffs. And I don't find that to be free trade in the least. And that actually sickens me as I sit there and look at my own freaking Nikes. I'm a hypocrite just like everybody else is, but don't call that free trade. And anyway, Wall Street Journal fell for that hook, line, and sinker. And it's too bad because they were the epitome of a pure capitalistic society, at least advocating for it for many years. And I just think they've kind of gone off the deep end, actually, which is unfortunate. Either way, all right, so enough of that. So here's Jeremy Siegel. He's a professor at Wharton, and he did the stocks for the long run book, which I have back there. 2 editions. You'll see I got both. I got 2 editions, one from 1994, I think, and one from 2009 or 10. One was before. This was after the Big Bear of 2008 and 9, and this was, I think, this was in '94 when he first wrote it. I think I got the original from 1994. I had a professor of economics named Howard Block at George Mason, who got me involved with Siegel stuff, French Fama, who run the DFA, Dimensional Fund Advisors, the Factor series of small cap value. I don't want to get into all that, but Dr. Block was a wonderful man. He passed away way too soon, but he has had an impact on me and introduced me to Siegel stuff in '94, and then all the other iterations of various research with Malkiel, French Fama, all these guys. So, all right, so let's see what Siegel says. Big cap tech stocks are a sucker's bet. March 14th, 2000. By Jeremy Siegel. Until Monday's sell-off, the NASDAQ enjoyed quite a run, surpassing 5,000 for the first time, even as the Dow Jones went through a correction. But are the valuations of the tech stocks that drive the NASDAQ justified? History suggests it's not. So we had a little bit of a sell-off, but remember, watch this. We're going to show you something here, and this is on Wikipedia. March 9th, 2000. I remember that was like yesterday, because does anything March 9th mean anything to you? March 9th. Why is that day important? March 9th of 2000 was when the NASDAQ hit its high at 5,046. March 9th of 2000. And never to come back for 15 years, my friends. And Siegel wrote that article, published on March 14th of 2000. Of course, he had written it a couple days before that. So he could not have called it any better. And from March 9th of 2000 to then back to March till end of February of 2003, the market, especially the tech stocks, were down 80%, my friends. 80%. All right. So Siegel could not have called it better. It's amazing. Now, is that luck? I don't know, but I'm going to go into a little bit more with Siegel, why you need to read this guy. March 9th of 2000, the NASDAQ his monthly is an all-time high until now. All right. Now, if we fast forward to March 9th of 2009, anyone? That's when the market hit its all-time low, or the all-time low for the Great Recession, March 9th of 2009. Anybody know why it stopped? Well, I did a video on how Barney Frank saved capitalism. And if that seems crazy, because Barney Frank is a liberal's liberal, and trust me, having lived in D.C. for many years, having done, the riding the bike in D.C. and delivering the papers to the Russell office building and whatnot, courier, I forgot what it's called. Courier, being a courier for a few years. Trust me, Barney Frank, you could not get more to the left of him, but he's a pragmatist, that's for sure. And he understood the basics of capitalism, no other way around that. So I've always had respect for Barney Frank. I think he's a liberal, I think Cambridge or something like that. But at the end of the day, he's always been one of those liberals that I've never met the guy, but I've always thought that he had a pretty good common sense, unlike what's happening nowadays. Ooh, it's bad. I'd take a Barney Frank liberal any day of the week over what we're seeing now, that's for sure. But anyway, so Barney Frank held hearings to get rid of mark-to-market accounting in March of 2009. And lo and behold, when they're holding hearings, that usually means there's going to be a rule passage to get rid of that. And sure enough, there was. And they got rid of it March 14th of 2009. And in March 9th of 2009, because everyone knew that the hearings were going to lead to a rule change, that was the bottoming out of the stock market for 2009 after the Great Recession. Not because of Ben Bernanke, not because of, I don't know, what's that guy's name? Not Greenspan, the guy, Paulson, Bush's guy, Paulson. Not because any of those guys are, Obama's guy? Geithner, not because of Geithner, Paulson, Ben Bernanke, Greenspan, none of these guys. No Larry Summers from Harvard economist? None of these guys. Is Barney Frank, who saved capitalism. Absolutely. And to his credit, I wish he'd get more credit, because I think he did a wonderful job. And frankly, Chris Dodd. And I don't like Chris Dodd at all. The guy's never, anyway, let's just put it this way. Barney Frank saved capitalism, and it still had to go through the Senate, my understanding, right? They did the Frank-Dodd, which is bad legislation. But Dodd, I think, as well, joined with Frank to at least get rid of mark-to-market accounting. And those are Democrats, liberal too. So more power to them. All right, so let's keep looking here and talk more about Jeremy Siegel. So after all these years, here's an article less than a year ago. Jeremy Siegel is still bullish after all these years. So why did and I'm sweating because I just got out of a shower. I just went for a jog, got out of the shower, and I got this light shine on me. If you see me sweat, I apologize. But I've just been thinking about this all morning long and how to get it out there. All right. Jerry Siegel has never lacked enthusiasm for the market. Well, that's simply not true. He did lack enthusiasm for the market when he needed to lack enthusiasm for the market. 2000, he said explicitly, the big tech stocks are sucker bet. So the idea they never lacked enthusiasm for the market is simply not right. Even 9 years into one of the strongest stock market recoveries in the history, the bull market is not yet over, says Siegel, who's been a professor since 1976. This should not come as a surprise, because his book in 1994, right there, Stocks for the Long Run, helps cement the conventional wisdom that stocks are a better bet for long-term investors than other popular investments such as bonds and gold. Siegel's timing could not have been better. A year after his book, U.S. stocks went on an epic run. The S&P more than tripled from 95 to 1999. And see, that's bullcrap, because the market bottomed out in 1982, and because of Reagan and Volcker, the market took off in 1982 like a bat out of hell. And so you can't say, oh, he just rode the wave from 95 to 99. It wasn't because of that. It's from 1982 until 1999, the market kicked butt, took name. Averaged 18% a year in that 17-year time frame, my friend. So the idea that Siegel just happened to get on board of the bandwagon before it left the station. It's crazy. As the market marched higher, a growing chorus of observers warned that the rally was overdone. One of them was Schiller, Robert Schiller. I'm a big fan of Robert Schiller from Yale. And their friends, they talk all, I'm just a huge fan of Schiller too, who argued in his 2000 book, Irrational Exuberance, that stocks had become dangerously rich. Well, Siegel did too. We just saw it in the Wall Street Journal. Schiller's it's called CAPE, cyclically adjusted PE ratio for U.S. stocks climbed to 44.2 by the end of 1999. Well above historical averages, which was about 15.5 since 1881. To this day, that's the highest CAPE ever recorded. So a lot of doomsayers are saying CAPE, cyclically adjusted price to earnings ratios, are way too high relative to the market as a whole historically. So a bear market, we're doomed, I tell you. Schiller wasn't the only one concerned about the market, and they do say Siegel too warned in technology in March 2000 that technology stocks were a sucker bet days before the NASDAQ tumbled. But Siegel also thought that many non-tech stocks were reasonably priced. And armed with 2 centuries of stock market data, he predicted 2 months later the stocks would continue to deliver their historical average real return of 7% a year over the medium and longer term. Frankly, it turned out to be correct if you look at the longer term as 15 years as opposed to, basically the prognostication in any financial industry. The long term is like 6 months. Hasn't quite worked out that way. S&P has averaged 5.4% a year since 2000, including dividends, which, that's okay. That's 3.2% real return. So Siegel's been off. I don't deny that in the least. During the same period, the Bloomberg's index, but it still wasn't like he was losing money or anything like that. But at the end of the day, I get it. They're saying, hey, since this time right here, Siegel has averaged, the market has averaged 3.2 real, and Siegel is predicting 7% real. All right. So, but we didn't see this right there. Boom, that big sell-off. The S&P has averaged 3.2% real. During the same period, Barclays aggregate bond and gold index have returned 5.1 and 8.7% respectively. And we can talk about why that is, but that's okay because that's a fact. That is what happened. Siegel was wrong relative to stocks versus bonds and gold since the end of 1999. All right. There's just no getting around that. 2 decades after its record peak in 1999, the CAPE is flashing warning signs again. The S&P has tripled since 2009. The CAPE stands at 31.3 as of November 2017, nearly double its long-term average. It was only higher on the eve of the Great Depression in 1929 and during the dot-com mania of 1990s. Nevertheless, Siegel said the stock market is fairly valued now. Siegel, how could you say that? My goodness, don't you see the CAPE is way higher than the only 2 other times during the Great Depression and the eve of the dot-com bubble. Nevertheless, he expects it to deliver a 5% real return, that's the stock market, over from its current level, well above the CAPE's implied earnings of 3.2%. And the CAPE ratio, in other words, is a false profit. Siegel is one of the few finance thinkers with the gravitas to take on the vaunted CAPE ratio. Let's see, we talk about who he's been. Okay, we'll go over there. Over the years, okay. You can read all this. Underlying his disagreement with the CAPE ratio is one of the oldest debates in accounting. So listen, my friends, this is huge. For decades, the GAAP, generally accepted accounting principles, required public companies to account for assets based on their acquisition cost basis. And it's not even really the cost basis because you're going to depreciate those assets too, but based on how much they paid for it, that's how they had to account for the assets in their total net worth. Critics complain, however, that ignoring assets' market prices misstated, i.e. undervalued, their true value. In response, the FASB, the Financial Accounting Standards Board, issued its first of several mark-to-market rules in 1993, which require companies to account for some assets based on their market value rather than historical cost. The basic idea is that companies must adjust the value for those assets when their prices change and recognize a gain or loss as appropriate. The problem is that asset prices tend to decline during recessions, you think, and marking them to market pulls down earnings when companies are struggling to remain profitable. It just pulls down paper reported earnings. As Siegel sees it, when GAAP changed to mark-to-market accounting, it changed the character of earnings during recessions, making them much more severe. That's been true of earnings recessions since the rule change in 1993. The GAP's S&P GAP's earnings declined 54% from their peak in September 2000 to December 2001, according to Schiller's data. Earnings also declined by a breathtaking 92% from June to March 2007 to March 2009. Siegel points out the 2008 financial crisis saw a much worse drop in earnings than the Great Depression, which doesn't make any sense because the Great Depression was 5 times worse. But yet we had a 92% drop in earnings from 2007 to March of 2009. Why? Because there was no market for these assets these people had. There was no buyers. There was only sellers. And when the market drops like a brick in water, they have to reprice them and reprice them and reprice them and reprice them down and down and down and down. And there's no market for the buyer. That means they're pricing these suckers at zero. Even if they just paid $1 billion for it, that means they lost $1 billion of their assets, but they still own the asset. There is just no market value for it because of stupid mark to market. They give you this chart right here. Look at that. Do you really think from 2007 to 2009, the S&P 500 fell by a true 92%? No way. No way. And lower earnings, of course, translate into higher PE ratios. Thus, the CAPE ratio has been perplexingly high since the change in mark-to-market accounting. The CAPE was below its long-term average during 56% of the months from 1881 to 1992. But since 1993, that number has dropped to just 2.3%. Why? Because they changed the accounting rules to mark-to-market accounting. Using operating earnings, says Siegel, you don't see the same overvaluation as you do with GAAP earnings. Operating earnings exclude the impact of mark-to-market accounting and other non-recurring items. According to many calculations, the average CAPE ratio using operating earnings has been 23 since December 1998, the earliest date for which it can be calculated, compared with 26.5 on GAAP earnings. And the CAPE ratio is 27.3 as of November using operating earnings compared to 31.3 for GAAP ratios. So now Siegel concedes that stocks aren't cheap. I was going to say, these are saying at the end of the day, these aren't cheap. Don't get me wrong. 23 PE ratio is not a cheap PE ratio. 27 is not a cheap PE ratio. Historically, it's been 15.5 to 16, but historical numbers are different because of the mark-to-market accounting rules and whatnot. But either way, at the end of the day, 16 is historical. Just use that for a number, and we're looking at 23 since December 1993. So stocks are highly valued, much more highly valued than they've been historically. That is true, but that's only one side of the equation. Let's see if Siegel talks about it. Historical CAPEs would be higher if mark-to-market accounting applied the entire series because earnings would be lower due to write-downs, he said. He also thinks it was the cost of owning an S&P 500 index fund approaching zero. Investors are willing to pay more for stocks than they once were. I don't know about that, but I get what he's saying. Hey, the cost of transactions are basically nothing, so people can go in there easier than they could before, allowing more buyers into the market because more people have assets to deploy into the market because the cost of entry is low. There are reasons whether the CAPE has lost its predictive power, as Siegel suspects. Consider that the S&P 500 returned 10.3% annually from 26 in 1992, February 26. The CAPE ratio averaged 14.7 during that time. Since then, the CAPE has jumped to 26.4, and yet the S&P 500 has still managed to return 9.7% a year from 1992 until November of this past year, 2017. Also, the CAPE has been useless in recent years. It climbed above its long-term average in June 2009 and kept climbing while the market had just come off its bottom. And now let's see, but they don't talk about. Still, Siegel has been right to ignore the CAPE's warning in recent years. The right man with a timely message. Okay, what they don't talk about though, and Siegel does know things, but you got to still look. What's the 10-year Treasury doing? Historically, it's been 6, and right now the 10-year Treasury is at 3. So we just hit 3, as you can see there, 3%. See, TNX, that's a 10-year Treasury. So the 10-year Treasury is trading at 50% as less of an interest. Let me bring myself up here a little bit. Actually, I tell you what, I think I have another article I want to. No, I'm good. All right. Yeah. All right. So the 10-year Treasury is trading at half. All right, so basically, you could take $100,000 and lock it up. Yeah, you can see my sweat. Sorry, guys. Hope that doesn't disgust you, but that's what happens when you get exercise and you got that light shine on you. All right, so you could take the 10-year Treasury, and back in the day, you get $6,000 a year for every $100,000 invested. Now you take that same $100,000, you only get $3,000. That's the difference. So if I am looking at stocks versus bonds, that's what you look at. You look at assets, real estate, stocks versus bonds. You look at those 3 things. And real estate is not cheap. No one's going to argue real estate is cheap. Stocks are pricey relative to historical norms, but so are bonds. I mean, because the reason the yields are so low on bonds is because the prices are high. Price high, I can't see my hands. Price goes up, yields go down. That's all there is to it. Price goes down, yield go up. That's why in 1982, you could have bought a bond for a 30-year bond of 15 and a quarter. That was a yield because no one wanted to touch locking their money for 30 years in high inflation. Every one of their moms said, I don't want to do that. So because of that, there's no buyers. No buyers means the yield creeps up to grab more buyers, and finally they hit an equilibrium. Pure capitalism at its finest. I will give you more and more and more yield until I reach a point where I have enough buyers who are willing to risk their long-term money for that yield they're going to get. Turned out, if you were a buyer in 1982, you made a wonderful purchase, that's for sure. But remember, back then, they did not know the results of the Reagan-Volcker interest-raising endeavor in order to beat inflation. It worked, but no one knew that was going to happen. We had no historical context to think that would or not. So at the end of the day, Siegel says, yes, stocks are trading at high prices relative to historical norms. Yes, if we take out the mark-to-market accounting, they're still high. No getting around that. But so aren't bonds as well. So isn't real estate as well. Every asset out there is priced highly. And if you look at historical earnings and you get 5.5%, like I talked about many times over, 2% dividends, you're getting 7.5% nominal. You factor out 2.5% to 3% inflation, you're getting 4.5% real return on stocks. Will it come to that? I don't know, but Siegel calls it. I'm following what he says, absolutely. And if you take that 3%, 10-year treasury, TNX, 10-year treasury, 3%, you factor in, you got to pay tax. Well, you only have to factor taxes. We didn't do it on the stocks, but still, you take a 2.5% to 3% inflation, you're making all of 1% to nothing after inflation. After taxes, inflation is even worse for bonds than it is for stocks because taxes are a full income, ordinary income on the full 3% that you're receiving as an interest payment, a coupon from the bond, where capital gains, long-term capital gains, and qualified dividends are taxed at 0 to 15%, depending on your tax bracket on the stocks. So you factor in inflation, you factor in taxes, stocks look even better, absolutely, relative to bonds. Now, relative to real estate ain't cheap either. So yeah, I'm not going to talk about that, but that's another. You got real estate, bonds, stocks. The three primary components of most middle-class Americans. You got your house, you got your portfolio, and that's what you have. You might have some money in CDs. At the end of the day, you have to look at all three. Are any of those things traded cheaply? The answer is no. Are stocks overvalued relative to historical norms? Yep. Are bonds overvalued relative to historical norms? Yep. And the real estate, the answer is yes. So make your decision wisely, but I just like the idea of understanding what Jeremy Siegel talks about, because the man knows his stuff. Now, again, every prognosticator is going to be wrong. That's a fact. That's why you just diversify. You don't go into individual stocks. Just diversify into a mix of portfolios of international, your real estate holdings. I don't like bonds, but that's fine. And then you'll be protected for that day that Siegel's wrong, and maybe Robert Shiller's right. I don't know, but being diversified is the way to play with a highly valued market. That's not just stocks, but stocks, bonds, and real estate. All right. Hope you like this stuff, my friends. I just saw this and I had to talk about it because I'm a big fan of Siegel, as you can tell. Subscribe down below. Comments always welcome, for sure. Comment. And then don't forget thumbs up too. And go to the blog at heritagewealthplanning.com. Got lots of stuff on there as well. So we'll see you next time. Thanks, guys.